Hey folks, Corey Kupfer here. I'm so excited to have Liz Nesvold on an upcoming episode of DealQuest. Liz is a wealth management RA industry friend for many, many years, one of the tops in the space. Liz, tell the folks what they're going to hear about on your episode of DealQuest.
Oh boy, I think we'll talk about advisors doing deals. Can anyone do a deal? How do you think about it if it's your first time? What are some trends around the M&A space that we're seeing, and I guess the dreaded continuity planning that the industry still has to wrestle with.
I love it. And maybe you'll be willing to give us a little insight into your own deal on why you sold Silver Lane to Raymond James, so we can hear a little bit about that.
Sure. Happy to.
Okay, great. So folks, check out the upcoming episode of DealQuest with Liz Nesvold. I'm telling you, it's going to be a great episode.
Thank you. Look forward to seeing everybody.
Do you want your business to grow faster? Are you open to new and out-of-the-box ways to drive revenues and increase value? How do you imagine the most successful entrepreneurs and business leaders double, triple, or expand their businesses tenfold or more? The answer is Deals. This is a weekly podcast featuring conversations with business owners, executives, and leaders as we reveal behind-the-scenes details that give you, our listeners, the confidence to pursue your own deal-driven growth. On the show, we discuss a huge variety of deals, everything from large, complex mergers and acquisitions to smaller deals that you can do even without significant capital. My name is Corey Kupfer, and I've been supporting deal-driven growth for businesses for 35 years as a successful entrepreneur, professional negotiator, and attorney. My goal is to help you strategize, plan for, find, and complete deals that will help your company grow faster. Welcome to the DealQuest Podcast. Let's get started.
DealQuest listeners, I am so excited to have Liz Nesvold on this episode of DealQuest. Elizabeth Nesvold is the Managing Director, Head of Asset and Wealth Management, Investment Banking, New York at Raymond James. She joined Raymond James in 2019 as part of an acquisition of Silver Lane Advisors, which is originally how Liz and I met when she was running Silver Lane. She has been described as the most experienced female investment banker specializing in the investment management and securities industry by Mergers and Acquisitions magazine. And while that's true, I would just describe her personally as one of the most experienced investment bankers, period, in the industry. Over the past 25 years, she has advised approximately 170 completed M&A valuation and strategic advisory assignments for a variety of clients, including institutional managers, both traditional and alternative, trust companies, multifamily offices, investment counsels, financial planners, and investment consultants. Prior to joining Raymond James, Ms. Nesvold founded Silver Lane in 2007. Before Silver Lane, Liz spent 15 years at another investment bank where she co-founded and led the first wealth management specialist M&A advisory group in the investment banking industry. So you can get that, the first wealth management specialist M&A advisory group in the wealth in the investment banking industry. And for folks who don't know the industry, by the way, that's significant because this is an industry that, as it's matured, in the beginning, nobody paid attention to it, frankly. And as it's matured, there's become huge opportunities. And Liz was very, very early on. She was one of only two female partners at the time of her departure and also served on the operating committee. As a member of Young Presidents Organization, she earned a BA in political science, a minor in economics from Binghamton. So she's a fellow state school person. I'm a Stony Brook guy. And an MBA in finance with high honors from Fordham University Graduate School of Business. Liz and I have known each other for, over a decade now, and, have done some fun stuff together. And she really is one of the premier folks in the investment banking field in the services around wealth management, investment management, financial services, and related. And so I am so excited, Liz, to have you on the DealQuest podcast.
Oh my goodness. Now I'm going to have to wipe some tears away. That was so sweet. Thank you.
Listen, I always, there are a number of folks who do it. And I'm not saying that I don't have relationships, but I feel like from the time we first met, I've always been, unbelievably impressed with you. And not just as a professional and obviously with your track record and your credentials, but just as a great person to work with. So I am
right back at you.
Appreciate you having you.
I'm delighted to be here.
So we're going to take you back before we talk about all this amazing stuff and what's going on in the industry and what you see and why you sold Silver Lane. And I'm going to take you back to when you were growing up as a little girl. What did you want to be? Because I have a sense it likely wasn't an investment banker in the wealth management financial services space, but you tell me if I'm wrong.
Oh my goodness. So I thought I would be in construction, actually running my dad's company, which was a steel erection business. I grew up around iron workers and, pickup trucks and big rigs. And, I think weirdly, I didn't want to be a ballerina or anything like that, but I thought I'd be in construction.
Wow.
Nobody ever asked me that question.
It's
so
funny because I get that a lot. And I always thought the podcast that way because it is frankly something that most people aren't prepared for. And it gives insight into the guest that I love, and my joke always is, I think it's almost always been true that almost nobody is doing whatever they thought they wanted to do as a little kid. Right. So occasionally different. So, all right, one more question looking back. What was your first deal of any type? It could be like something when you were a kid or older or early in your career, whatever comes to mind.
Oh my gosh. Well, having taken home ec class in junior high, I learned to sew. And so I sewed bags. Quilted bags, and I turned it into a company, and it was called Designs by Lizzie B. And I sold it to local merchants, and they resold it. So my first business was at the age of, I think it was 15 at the time.
I love that because that's when I had my first real business with. They weren't employees because I certainly wasn't withholding taxes when my friends were delivering flyers door to door. So let's call them independent contractors. So
I'm sure I owe some back taxes for those bags. I did not declare as I reflect on that.
I love it. So what got you into, I mean, obviously from your bio, I sort of made a comment on it. You got into, especially the investment banking side around, wealth management and financial services and related, services pretty early in the independent advisor movement and early in the maturation of the industry. What got you into that? How did you end up in that field?
Oh my goodness. Just even getting into M&A, it almost was a fluke. So I came to New York, the upstate New York kid. My husband jokes with me and says, I saw New York City and said, "Oh, New York City, isn't it wonderful, mother?" And just always knew that I would be here. But, I interviewed at all kinds of places. And back then, you really had to come in as an assistant. But I stepped into a firm that was focused on mergers and acquisitions, mostly around the securities industry and asset management at the time. And then as I progressed in my career, you get to a point where, there was no training program. They just say one day you're an officer and now you got to go produce. There was everything seemed to be covered. Everybody was covering the big insurance companies, the big broker dealers, the big asset managers with mutual fund complexes. And the only space that I had seen that I had done at least one deal in was investment counsel. And they were lovely people. Thinking way, way, way back when, a little investment counselor somewhere in Tennessee. And I just thought this is a nice place to get my footing. So I just, as a banker that had to have production requirements, started calling on these small firms, which a big firm in what we now call wealth management at the time was maybe 300 million to 500 million in assets. And so, I was fortunate enough to get some traction and nobody was covering the space. So I set up a practice group around that so that more colleagues could start to pay attention to it, and started, staying focused on family offices, single family offices, And the likely acquirers were private banks and trust companies and, local institutions. That's really how I got my footing. So kind of dumb luck all the way in.
Well, it's funny you say, as a little aside, you say, the right to 500 million was, big then, right? I just did a half day whiteboarding session with a client who's looking to do acquisitions, and they're, approaching 300 million. And, and it's been around for a while, and, was joking that now everybody refers to him as small, like really. And he said somebody he was talking to in the industry said, who was another firm said, yeah, and said to him, we're really small. We're only 1.2 billion,
Yeah.
So like it's all perspective, timing, comparison, right?
Yeah. Well, it's one of those things where, never say never. I try to talk to everybody, and while I can't thank everybody, give a little bit of advice. But my best repeat client, and unfortunately I'm not allowed to say names as my parent company, but I did 5 deals with one firm that cold called me when they were 500 million in assets. And the final trip for us, they were probably 8-9 billion in assets. So never say never. You got to get your start somewhere, and there's a deal for every size firm that's out there.
I love it. So let's sort of, I want to jump to the present, and then we're going to go back to, sort of how you got here. So, you're currently at Raymond James. Talk a little bit about the kind of deals you're doing now, in the industry at Raymond James.
Boy, I would say, size-wise, all over the map. It could be as small as a firm with 30 million franchise value, and as large as one with 400 or 500 million in franchise value and beyond. The really, really big ones don't happen often. So I think we've done some 28 deals in the 2 years we've been associated with Raymond James. So, by and large, more of the deals that are occurring are probably in the, $25 to $100 million size range than the mega deals that everybody reads about. But that's where we spend our time, and it really does run the gamut from the fee-only financial planner to the wealth solutions TAMP business to somebody who's working in the family office space who's trying to merge in with someone who can bring some resources to bear. It's all over the map, and it keeps me on my toes.
Love it. So before, I definitely want to get your insight into trends and what's going on, the impact of the potential raise in capital gains rates, and, all the money that's coming into the industry. But before we go there, I do want to talk a little bit about your decision, right? You co-founded and ran Silver Lane for many, many years, a highly successful firm. You certainly, at least in my outside view, didn't need to do a deal. You could have been very fine, just continuing doing what you're doing. But you chose to do a deal with Raymond James 2 years ago. And I'm curious as to, what was that motivation? What were the reasons for doing it? And, I'm laughing a little bit because it sort of puts you in a position where a lot of your clients are in, right, who are looking, making that decision on whether or not they should sell. So I'm curious if there's any learnings or lessons that you got, or reasons that sort of coincide, with what comes up for your clients as well in that decision.
Sure. Yeah, it's been a pretty incredible experience being on the other side of this.
Right.
So I am much more attuned to things that, as a banker, you never would have thought you needed to pay attention to just on the post-closing front. But in terms of why we even considered it, we had gotten to a point where we were, I'm going to knock on wood, fortunately, people have been very kind to us over the years, and Silver Lane was known. And a UK firm called us to pitch for a piece of business, and it was a sizable firm. And at the end of the day, that leadership team knew we had better experience than the advisor that they picked, but we didn't have boots on the ground in the UK. And even though they were looking for a US partner, and this is several years back, I just walked away frustrated saying, gosh, what should we do here? Should we start to think about a combination? I actually did have a couple of interesting conversations with firms that and advisors who, M&A advisors who are thinking of leaving. But, we sort of put that on the back burner. You go about your business. And then we had done a ton of work for a firm that ultimately took private equity money in and then ultimately transacted, and did our debrief and say, okay, we did all this work, helped you grow, why didn't you call on us? And then what we realized of the big boys is that there is you have to have deal flow that you've shown them repeatedly, because invariably it's a tip out. So we were not on the tip out list as a small boutique that might show somebody only a couple of deals a year. So that was another frustration. And the last thing that showed up on the list was we got to the point where we had a partner who wanted to do something different. And she had a pretty good chunk of ownership, and trying to, we were fortunate to be successful, but to try and address that way earlier than I ever anticipated, ownership transition required us to think again. So we sat as partners and decided that all the people that had called on us would be much more proactive about having discussions, and did exactly what we tell our clients to do. We actually had an advisor, a wonderful banker who retired from doing really big deals, who's a dear friend of mine, Keith Mitchell, who was of great counsel as we thought through the process, but made sure that we followed our own blueprints for our clients, and navigated to what we were trying to accomplish versus the players that were in the marketplace. But those are some of the things that prompted us to think about it. It was really, for most of us, it was about growth and continuing to build. But for one of us, invariably, we see this. You see it a lot, Corey. I see it. Continuity planning. Often you have a window into that, given partners' time horizons. But once in a while, you get somebody who's 49, 50, and just says, "No mas. I want to do something different," and it was something to address.
Great. So let's talk about what's going on in the industry, right? I mean, you and I worked together on a matter that the client was anxious to get closed before the end of the year, last year, just in case capital gains rates went up in 2021. I think that particular client acknowledged, and we all felt that it was unlikely that something was happening in 21. But you know what? If you can get the deal done and be sure, why not? On the risk of rates going up. Certainly now, I mean, I'm seeing folks continuing to potentially push to get deals done by the end of this year, because if there is going to be I think it's a big question on whether Democrats are going to be able to get it through, and not, without commenting politically either way, we have to plan as advisors for what might happen. I've seen some acceleration of folks looking to get deals closed this year just in case. What are you seeing out there? How much is the risk of capital gains going up, quote unquote, impacting what you're seeing?
Oh my goodness. Historically, changing tax landscape would never be on the list of us to say, hey, do a deal because. Yep. But I would say that's probably a piece of the puzzle for some of the firms that are really pressing to transact in the current year. And in some instances, it's sort of sped up a lot of the continuity planning, succession planning that you and I both know needed to occur in an industry where the key principals are aging. And so, if you're in the middle of your deal, is it better to get it done in this current fiscal year than next? Probably, tax year anyway. But we have people calling us to say, hey, if we start now, can we get it done by 12/31? And the answer is, it would be very tight. It would be very, very tight, and you got to run fast. And we do run fast. I know you run fast, and 5-6 months to run a very thoughtful process leaves you with time to really figure out who makes sense for the business, trying to jam a deal in 3-4 months. This is the equivalent of, Britney Spears going to Vegas to get hitched. We know how that turned out after 6 weeks.
Right. I love it. And listen, I feel like there are many things we've talked about over the years, but you and I are aligned. And I do think, I did a solo cast talking specifically here on DealQuest on the capital. In fact, I did two on capital gains. And one of the things I've said is, if you look historically, some people panic, right? And it's one thing to take something into account as a factor, and it's another thing to fixate or panic on one single factor, right?
Yeah. Yes.
And if you study deal flow and capital gains rates, for example, in the 90s, capital gains rates were higher than even what is being proposed to go up to now. We're going to get there, and it was a boom time for deals, right? I'm not saying there's no impact of capital gains on deals. I'm just saying it's one factor, and there's all kinds of other factors: economy, access to capital, stage of ownership, age, all whatever, right? So one of my messages was, hey, yeah, if you originally looking at doing a deal 5 years out, it's probably not going to be the thing to rush to get a deal done this year. If you had a 12 to 18 month horizon, okay, maybe, maybe, it may make sense to accelerate it. So, yeah, but I'm definitely seeing some folks who are looking to push. So we've been, we were busy. We've been busy in general anyway, but we're certainly busy last year, and we're seeing a lot of deal flow this year. So, that's good. What else do you see? Listen, obviously when I get interviewed, the capital options that have come into just 10, 12 years ago, there was almost, it was so limited. Last decade, the capital options that have come in this space. I said to a client, actually, I think it was on an interview the other day, that I sort of feel like in this day and age, and I'm wondering if you agree with me, there's no good deal in the wealth management space that there's not capital available for.
It is a plenty, and I think it's still confusing to the marketplace in terms of who provides what over what time horizon. What are the benefits? Is it tax efficient? What are the risks? But there are more solutions today, more flavors of ice cream across the entire spectrum of financing to sort of financial with a strategic bias, to strategic non-integrators, even to strategic full-on integrators and aggregators, than I've ever seen in my 30 years. It is unbelievable. And what had been missing, if we went back 3-4 years ago, is a number of strategics. But now, again, I'm not allowed to name names, but at least we can think of one outside this country who's been very busy.
Yes.
There are more strategics today.
To the north of us, right?
No direction. But all that being said, it is from my perspective, it's a good thing for the market to have access to, because of all financial services, the wealth advisor community had a dearth of choice.
Yes.
If you go back 10 years, and I like to think we brought every choice that could have been possible relative to the partner criteria. But now it's very confusing to them. It is almost a big part of our objective now is to help them understand why these names that they know either fit or just don't fit remotely what they're trying to accomplish. And if they don't fit, then who should they be talking to, and how do they need to think about it, and how do they do their reverse due diligence? And it's just a very confusing time.
I really agree with that. I sort of feel like it was, for me, going back, 8-10 years ago, whatever, and over that period, I think there was a really confused, that's when a lot of the aggregators and platforms and service, started really coming in, right? And I remember spending a huge amount of time, over those years, helping people understand the difference between, Focus Financial's model and Hightower's model and model and whatever, and that was the confusion, right? Because there were all these new options coming in there, and now I feel like it is the same thing. With financing, because you've got you've got private equity, you've got, strategic buyers, you've got, up until the more recent trend is a lot more minority investors, right? Some recent announcements on new, minority investment companies or programs from existing firms. I think that's, I sort of draw this equivalent to, I think people are more confused about financing now. They used to be more confused about, and there's still some confusion about the various platforms or aggregators or deal structures out there. So, it harks me back to when I was getting a lot of questions on comparing the new aggregators.
Yeah, absolutely. Well, and what is great, and you just hit on it, is, minority solutions. From my perspective, the industry became flooded, let's say, 4 or 5 years ago, with choice. But the dearth of choice was still in the minority solution space. So for me, I would say we spend a ton of our time looking at deals in that space right now and having clients that really are looking for elections in minority financing, minority partners, minority sponsor investors. And I'm so pleased that is a bit of the change that we're seeing, because what that means is, and for a firm like ours at Silver Lane, that is commission heavy. So we start January 1 with $0 on our P&L. It's hard to recap and take a partner out when you start with $0 and you hope your P&L is going to be better than it was last year. But with a reasonably predictable earnings pattern for some of these firms, it's easier for someone to get comfortable to take a minority stake. Yeah. And so that was missing. And so it is wonderful that these are choices, because these are also choices for firms that want to perpetuate the independent model. And that was missing as well.
Yeah, and I've seen, I don't know, I've seen, there's a couple of things that helps facilitate. One is growth capital without the founders losing control, right? And then two is, with some folks, it's the ability to take, a lot of them are using it for growth capital, but I've seen some situations where they get to take some of the chips off the table. It's a nice hedge. They get to take a little bit off and then they can keep growing, which obviously, before there were all these minority investment opportunities, you really didn't have. I mean, if you want to take a growth capital, you were taking somebody who was either, taking at least a controlling interest. And, if you wanted to take chips off the table, it was harder to find those kind of investors. And I've seen, it's been interesting to me to see, because, just because somebody's willing to invest doesn't mean that they're going to allow you to take money out of the company. They may want it in the company, but I've seen situations where they're okay with it, with somebody who's more senior saying, hey, I want to take some chips off the table.
Absolutely. And it's nice that people do have choice, because for partners who are in growth mode, it's great to have somebody who will reinvest or infuse capital for sub-acquisitions or office expansions or service expansions. And for those founders who may be at a different time horizon in their professional evolution, to be able to take the liquidity that they need, that would put too much pressure on their next generation owners if they had to absorb it in-house themselves. So it's great to see this.
Let's take a break from the show for a minute so I can invite you to a new way to determine your deal readiness. I created a fast and easy assessment that will determine exactly how deal ready you are. Once you complete the assessment, I use your responses to identify the obstacles that are holding you back from being a deal-driven growth genius. It's as easy as heading to CoreyKupfer.com/assessment. That's CoreyKupfer.com/assessment, and filling out a few multiple choice questions. I'll be checking in after the episode to see what your results are. Now back to the show.
So you mentioned earlier, the concept obviously of succession and the owners getting older, and and I feel like you, me, and many of us, have been talking about.
Oh, no. We're not getting older. We're not getting older.
Exactly. But those people, those other people.
The other people.
They, despite the fact that we're not getting older, we've been talking about this stuff for over a decade, right? If not more. And, and I don't know, I sort of feel like a lot of us, you can tell me it's different, anticipated that the pace of succession, would be maybe higher than it's been. And some folks in the industry will say there's even a backlog. I mean, for me, we've also been in basically a 10-year bull market, right? So, I think that's a big factor, right? When things are flowing along and everybody's, making more money, each year, even if you're not adding new clients, why? Like it's and then we had that little scare, right? Over a year ago, was March, April, where we had that big dip, and then of course things came back up, and we happen to be in an industry in that K economy they talk about that did very well last year, But what do you, have you seen on your side any, acceleration? I mean, obviously, on the succession side, do you think there really are factors? Is it going to take till the next downturn when people look and say, I don't want to go through another 3-5 years before this comes back up? What are your thoughts? Where we are on that?
You know what, you hit the nail on the head, and it was such a brief free fall. Is that the right way to explain it? And rally back that, it is quite possible that some of the succession that is built up in the model just didn't come to fruition. Then come the prospective tax changes, and now people put their heads up. But I mean, as incredible numbers of transactions that have been occurring year after year over the last 5 years, when you look at the industry in the aggregate, only 3% of the industry, or even less than that, of the registered investment advisory industry, not advisors who sit on other platforms that aren't registered, because this is what we track, less than 3% is transacting in any given year. But yet the industry continues to flourish and perpetuate the model. So advisors combine, new advisors come in, the number of RIAs is greater than it was the year prior. And there's still a ton of firms that haven't really addressed their continuity planning. They do a great job for the clients, but still need to think about yourself. And so, I do think there'll be more activity over the next several years. And in the changing tax landscape, it is going to prompt people to revisit structure and how they assess deals, because the disparity between ordinary income and long-term cap gains, may shrink. I don't know how much, but more than maybe anticipated. And that may require more creativity on the way you approach structuring to induce sellers to want to transact, because the income that they earn may all of a sudden become very attractive. And I worry a little bit, even though I know there will be more pent-up demand for transacting, I worry a little bit that, the exchange for long-term cap gains versus ordinary income in a changed environment may prompt people to hold on to the cash flow that they have and not transact, and maybe not even push that ownership down to next gen, and invite more people into the ownership, because they'll be holding on to the cash flow for, the next 5-10 years. So we'll see what happens, but I don't think the activity is going to slow by any means.
No, I don't either. And, and there's so many more reasons, however, the industry should be doing better on next gen in addition to succession. I mean, right. And just even people coming into the industry, getting trained up and, and whatever, so I'm hoping, a lot of people have talked about that, but I don't know how well, how much has really been done. And it's interesting to me because it's such an attractive industry in so many ways, right? It's lucrative, for a lot of folks. You get to help people. There's so many reasons that it's interesting that it's not attracting, that the industry is still doing, at least in my view, not a great job of really attracting and then incentivizing and keeping some of the things we do is attraction and retention vehicles for, key employees, next gen folks, and how we structure that. But the point is, what you said, no matter how much we do, I mean, whenever I talk to people, whether you want to call it a path to partnership or path to equity or ownership, whatever, you're going to hit a bottleneck unless somebody is giving up and eventually going out on the other side, right? You can't have one without the other. They have to relate to each other.
Absolutely.
What do you see? So what are you seeing in terms of, sort of mentality. And part of it is, I guess I have two questions. I don't know if you want to comment more on the succession side. I'm open to that. But then also, there's this conversation of who's really a buyer and who's right, which we've been talking about for a long time.
Everybody's a buyer.
Yeah, everyone says they're a buyer, right? I made this comment to somebody. Why don't I start here? I'll agree or disagree, and I honestly say, just feel free to disagree if you disagree. I don't. But I have found, it's sort of like, we're way behind in succession planning, but there was a time where everybody was talking about nobody was doing anything. And then finally people heard it enough that at least some people put some stuff in place. I feel like we've been the same way with, this discussion we've had about everybody claims they're a buyer and really a lot of people aren't really ready to buy. I've actually had some of my clients who are small, let's say sub $1 billion, AUM, right? The $300, $500 million type clients, who have finally actually started doing more than talk about it. They've sort of taken what me and many others, have said to them about really what it means to be a buyer, and what you got to get in place, and why would people come to you? I was talking about then why and value proposition, building a model, and whatever. Have you seen any trend in that area? And then I guess the related question to me is, what is it that true buyers really do right, that other firms, need to learn from?
Oh boy.
Big topic.
That is a big topic. Well, let's just unpack that and just talk about buyers. I mean, you and I go into any virtual room now. Someday we'll get into a real room and ask, people to raise their hands if they think they're a buyer, and most everybody will do so. I think everybody's probably a buyer and a seller of sorts. Can anyone be a buyer? Yes, they can. It takes, let's say, a lot of preparation, consideration, flexibility, integrity, follow-up. But the earliest deals in this space that I would call intra-industry combinations were by smaller firms. So you make reference to a couple $100 million firm that's thinking about or starting to take the first steps to doing a deal. And the early deals that I can remember were beyond the big trust companies who were making the acquisitions for geographic plays, was firms combining to share resources and address continuity planning.
Yes.
So is that possible? Of course it's possible. What do good acquirers do well? They deliver on the promise. So they follow up well. They make it an easy process. It doesn't feel like a fight. It feels like a collaboration when you're really trying to think about things. And they follow through on if it's integration. They follow through with excellent integration and support. If it's digital engagement, they're helping with the digital engagement, the marketing. Or it could be as much as, you're taking a financial investor in who's made the articulation or the proposition that they will support in helping you source and execute deals. You need to do that, because I can assure you that we go back and, if you're on the other side of one of my clients, we're going to go back and talk to the people that you give us. And then we're going to go talk to all the people that you didn't tell us about, that you transacted with, or even somebody who left the firm. So does everybody do everything perfectly all the time? No, to err is human, but follow through is critical. So if a small firm does their first deal and wants to do the second, don't forget about the first. Make sure you nail that first deal, because that's how you're going to be gauged going forward, is the happiness and welfare of the team that committed to you for the first time round. So that's sort of, can anyone do it? Sure. What do the best people do? They deliver on the promise all day long.
Yeah, I agree with that. Yeah. The other thing I found, what do you think about this conversation? Because I have it with clients, not if somebody's going to do a one-off deal, but if a client says, hey, I want to grow through acquisition, I want it to become a program that I'm going to do. I always have a conversation with them on, let's figure out your model, right? Mm-hmm. Because we are in a competitive space, and it's sort of like if even people understand, a lot of them still don't even do a good job on having a differentiator or a unique value proposition, whatever, out to clients in the space. other than we really care about you and we'll do a good job. But I think they're starting to understand that in this competitive environment, they need that, whether they're doing an onboarding deals for employment onboarding deals, major acquisitions, tuck-ins, whatever it is. Why you, right? And then what are you offering? What's the model you're offering? It's not like to be all things to all people is never, at least in my opinion, the right thing. I think the bigger aggregators, what their model is. You can not like it, but that's actually a good thing, right? Like it's clear you get to opt in or opt out. Is that what you're seeing as well?
It's back to the early conversation that we had about, it's a busy, confusing marketplace. You have to nail the value prop. So if you're on the buy side, first point of departure is make sure you've done the homework on, is this candidate that I'm calling on the right candidate for us? And you can't know until you have the conversation, because so much of this is about cultural fit up front. But how will you help me? Here are the things that I'm looking for. Where do you fit? And how does that work for you? And if the answer is, let me think on that, that probably is a short conversation, or maybe it's a one-time conversation. And you have to know your strengths, and the areas that are not strengths are actually opportunities. I view those as opportunities, because you might find somebody who, if your real strength is business generation, lead generation, you're great at that, but you're a little weaker on the investment platform, then great, focus on somebody who's really nailed that. If you're doing more of the investment management, but not as much rigorous planning, find somebody who's in the planning space that would fit your model, the clientele, the footprint, et cetera. So knowing one's own strengths or value props and also weaknesses can actually be used as part of the pitch as well. You will own this domain. You're going to be the tax planning, focal point or center of excellence, or whatever you want to call it. That will be your domain, or the financial planning, or the estate planning, or the family governance, whatever it is. Know where you've got some areas for improvement, and use that gap analysis as a part of the pitch, the value prop for joining us, because we'll be able to bring your capabilities into a wider array of clientele.
Love it. Let me ask you what you're seeing in the evolution on deal structures. And obviously we all know there's no one deal structure, different deals, but in general, let's say, is there any trends in terms of cash versus equity deals or combinations? Is there any, I remember a time when it was pretty common to say to folks, well, a lot of deals are going to have a down payment of 25 to 33%, and those down payments pushed up significantly on the upfront money, seeing deals at 50, 70, percent. And some people have said maybe that's starting to ease back. Those are some examples, but in general, what are you seeing in terms of evolution of deal structure in recent times?
Yeah, that's a good question. It really is all over the map. There was a time where people really wanted a lot of equity, and then we moved to cash is king, and now we're back to, equity could be very interesting, and maybe that's a way to have another event down the road. I think the industry will, as opposed to this, we had these trappings of get as much cash as you can as quickly as you can. I think the industry will level out a little bit and start to look at the equity opportunity again, because it's a great retention tool for your top talent. It's a way to continue to add cash flow or distributions into your pocket. And it's also a way to create another opportunity for a bite at the apple down the road if everybody's collectively successful. So I'd like to see more in the equity bucket than as little or less as we might have seen in the last several years, because I think that's certainly going to be powerful for the next generation talent to want to stick around if they thought they were going to be partners.
Yeah, that's great. And any particular trends you're seeing on upfront money? The way I look at it is essentially on the shifting of risk, right, between buys and sells. I mean, obviously there's clawbacks and earnouts and whatever, but any trends you're seeing there in terms of the allocation of risk and timing of money? And
yeah, it depends on who the party is, but if it is somebody who's looking at the firm that's selling as the platform, the buyer tends to want to still risk mitigate to some extent, because they're going to really hope that you're going to be that investment wealth center of excellence for maybe a broader offering as a wrapper. So let's say a bank acquiring somebody in the RIA wealth space. If it's somebody who's already in the business, they may push the envelope in terms of the consideration, because they know there will be efficiencies in the business.
Right.
And so from their perspective, it might not look like they're paying as much cash. And also from their perspective, they may be using a fair bit of leverage. So the actual cash portion of the check that they're writing may actually be smaller than the seller on the other side feels like, wow, this is a great bit of cash up front. I'm very happy with these proceeds. So it certainly, you made a good comment about sort of pushing the envelope, and it's been an aggressive time for cash deployment and receipt. But I think that will taper off some as we move into 2022, 23, where equity currency will matter, where risk mitigation will matter. But it remains to be seen.
Great. All right. So before I ask you my final two questions, is there anything else that I haven't asked you about that, you're seeing in the industry, trends that we should be watching out for or talking about, or, lessons people are learning these days, or anything, that's of substance that you think we should cover?
Oh, boy. I will say that, we're in this SPAC craze right now, with a lot of SPACs that raised a lot of capital, a lot of desire to de-SPAC. I mentioned this to somebody the other day that I would like to see, I can't say that the industry will deliver for me, but I'd like to see more wealth managers in the public domain. And historically, it's just felt more attractive to be in the private domain, but I think there'll be reasons where being public could have huge benefits, especially if you're acquisitive, if you've got some goals for national expansion. But we'll see what happens there. There are just not that many publicly traded solutions right now. Boy, you've asked such good questions. I think you've really hit, you've caught my brain.
Great. Okay, so my second last question is, if people want to find out more about you and Silverline / Raymond James and what you guys do, what's the best place for them to go?
Oh my goodness. Well, the best way to get to me is probably on Raymond James' website. There you go. Corey has my contact info.
I love it. That's perfect. And folks, listen. Obviously, I will. You can always find Liz.
I could say you could link me in as well. I'm
like
always happy to link in.
And listen, Liz is been generous with her time here. She is very, very busy, and obviously needs to qualify the folks she spends with. But she's also been a great advocate of the industry, and as in fact, just sent me some folks who are sort of below her size and radar. Is always willing to help out, make sure people are taken care of. So appreciate that. Liz, my final question on the podcast always is that my highest value in life is freedom, and for me that means everything from freedom from people from oppression in the world to the reason I'm an entrepreneur and don't have a boss. What does freedom mean to you in life and business?
Oh my goodness, that's a toughie. You know what? I would say freedom to be passionate about the opportunities that I want to engage in. For me, it is I am a nurturer. I'm a mama. I love to mentor, and I love to be able to give to this industry. I love to be able to give back, and it is hard to be as free as I want to be when you have thresholds and requirements in a bigger corporate environment. But I'm passionate about the industry, and the more that I can give back in a variety of ways, the more the industry returns back to me. I've just been so blessed, for sure. That's a tough question.
Love it. It's like, hey, listen, I like to open and close on a way that's not, like trying to get people thinking and a little perspective there. So it's all great. I appreciate it. Liz, thank you so much for being an amazing guest on the DealQuest podcast.
Thank you so much, Corey, for having me. Thank you, everybody. Nice to see everybody. Be safe.
Thank you for joining me on this episode of DealQuest, where we help you understand how deal-driven growth can be your ticket to freedom. I want to invite you to a unique way to tap into the wisdom and experience of the DealQuest community. Join the DealQuest Deal Den Zoom calls, a free monthly 90-minute mastermind. In the mastermind, we address all the challenges you may be facing and help support you with the opportunities that may arise in terms of deal-driven growth. You will get input not only from me, but all the members on the call will collaborate and serve each other in a mastermind format. To sign up for the free mastermind, go to www.corykupfer.com/dealden. That's corykupfer.com/dealden. I'll see you there. I'm Corey Kupfer. Until next week, wishing you the freedom and financial prosperity that I know your DealQuest will bring.